Subscribe to our YouTube channel and press the bell icon to get the latest updates.
Hello friends, I'm Vijay Bambwani and I hope my videos are helping you become better investors and better traders in the markets, and these are helping add value to your journey as a profitable investor and trader. In this video, I want to talk to you about a very critical aspect of the market and shed a 360-degree worldview, which is something that I strongly believe in, which every investor must adopt so that he or she can avoid sudden shocks to the portfolio that the market sometimes is known to give. I'm specifically talking about the US dollar index, also known as the DXY in market slang parlance, which is now at almost a 5-year high. We are now at January 2017 highs, and there are bound to be repercussions of the dollar index going up. If you have been with me and watching my channel long enough, you will know that I basically believe in splitting the time period of the market, the time of the calendar, and adopting a strategy that is best suited to this calendar. Now, there is a time cycle in the market which I call the US election cycle, the presidential election cycle. So in 2020, we had the presidential election, and in 2022, to be precise, on 8th of November 2022, we have the US midterm elections. Now, the standard operating procedure, or the SOP, before every election is the same. I believe it would be uniformly applicable to almost all nations. Control inflation, strengthen the currency, make the economic data more flowery, more positive and optimistic, generate jobs, and generally give a feel-good factor to your voters, which is what the US is expected to do. So the US dollar index going to 103 plus and hitting a 5-year high is not really a surprise. Now you see what happens is, anything that you import, if your local currency or domestic currency is strong, anything that you import becomes cheaper. And the US is one of the biggest importers, or rather the biggest importers in the world. It's the largest debtor nation in the world. Now, when the dollar is strong, two things happen. Number one, it imports goods cheaper because the landed price is lower. The exporting nation's currency is weaker against the dollar. And secondly, the debt that US owes to the others becomes more manageable because they have to pay out fewer dollars. Unfortunately, the counter repercussions also occur. Now that the US is reducing its imported inflation by strengthening the dollar, it is exporting inflation to other countries. Other countries, especially emerging markets, including India. Is it likely going to impact some of your stocks in your portfolio? My gut feeling, or rather my data, suggests yes. I've talked about a sector in the past, the NBFC stocks, interest rate sensitives, which are likely to be feeling the heat almost immediately. By immediately, I don't mean Monday morning itself. In the marketplace, the wheels of time move a little slow, but it's like God's mill. It grinds slowly, but it grinds to a fine powder. So with a slight lag effect, you're going to feel imported inflation coming into the country, and we will have to match the US dollar strength by probably raising interest rates in the next Monetary Policy Committee, or the MPC meeting, in early June 2022. What really happens then when interest rates go up? Every industry that is dependent on EMI-based buying will suddenly start to feel the heat. And NBFCs, or non-banking financial corporations, typically borrow money from bankers, from fixed deposit investors, and NCDs, corporate deposits, etc. Now, to basically garner more money, they will have to match the rising interest rates and their cost of funds will go up. To that extent, in the near term, please mind my words, mark my words, near term, chances are companies with heavy borrowings and interest rate sensitive borrowings, especially from individual depositors where interest rates will have to rise faster. If they have access to institutional funds, maybe cost of funds will rise less rapidly, but they will rise. And NBFCs which have forex loans and they do borrow money from the international market will start to feel the heat, because if the dollar is 65, you need to spend 65 rupees to buy $1 to repay your dollar loans. But if the dollar goes to 67, you have to spend 67 rupees to buy $1 to repay your forex debt. Please be very, very aware about whether the company whose stock that you're buying has substantial amount of forex debt. And if it is not, what is the component of money that it has garnered from the market? Is it through institutions where the cost of funds will rise less rapidly? And if it is from individual investors, interest rates will have to be marked up. If you have a cell phone and your number has been given to telemarketers, you would have no doubt received many SMSs from banks, HDFC Limited, SBI, Axis Bank. All of these banks are now raising interest rates. And very simply put, cost of funds is going to go up. So as a sector, I think in the absolute near term, say starting from a couple of weeks to a couple of months. Remember my video about Edwin Kopok's oscillator? Bear market sentiments or bearish sentiments, if it is absolutely short term, last from 10 to 14 days. If they are intermediate term, 10 to 14 weeks. And if they are long term, 10 to 14 months. I don't think NBFCs will go into a long-term bear market, but it could be anything from short to intermediate term, and therefore they might just underperform. To an astute investor and trader, this is a wake-up call, and you need to move the chess pieces on the chessboard accordingly. I respect the fact that buy and hold for long term is a very viable and profitable strategy, but at the same time, the trader in me is asking a question as to whether I should be temporarily sinking with a sinking ship. Well, that sounds like a little extreme. No stock is sinking forever, but why go down when the price is going to go down? So shuffle your chess pieces on the board very, very smartly and go into alternates. On this cautious but optimistic note, because every problem has a solution for an intelligent investor like yourself, there is always a way out. On this cautious but optimistic note, I bid goodbye to you, not before reminding you to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so, and click on the bell icon to receive instant alerts about fresh videos being put up out here. Good, bad or ugly, I always welcome your feedback in the comments section. And please help us reach out to fellow like-minded investors and traders by referring our video to your family and friends. Thank you for your patience sticking with me in this video. Till we meet again in my next, this is Vijay Bambwani signing off for now. I wish you have a very, very profitable day ahead. Bye-bye.